So thank you for coming. The title of this talk is Impermanent Loss, Implied Impermanent Loss, a cross-sectional analysis of decentralized liquidity pools. So I'll explain as we go, or as I go through the slides, you'll realize what the different parts of the title mean. So we'll get to that. And there's myself, my former PhD student Tom Lee, Siddharth Naik from Switzerland, and Lorenzo Schoenleber are the collaborators on this work. And of course, we're here in Vilnius presenting. Let me stand over here. Let's consider the following situation. You'd like to trade BTC for ETH, or Bitcoin for Ethereum on a decentralized exchange or a DEX. This is a peer-to-peer trading platform. It's running on a blockchain. And so this is decentralized. There's no centralized exchange like FTX. The decentralized exchanges that people use today are like Uniswap, Curve. There's a few of them. What happens on these decentralized exchanges is that trading occurs in a liquidity pool using an automated market maker. There's no order book, there's no central market maker. So-called smart contracts are the entity through which people stake their tokens and become liquidity providers. So the AMM sets the price according to the constant product rule. So when you stake your tokens to these platforms, you're not a market maker in the centralized sense, because the AMM decides the price for you. You're merely a provider. Anyone can become a liquidity provider through the system, so that's one of the appealing things. The incentive to become a liquidity provider is that you can earn some of the trading fees. So people who use these pools to do this swap, say Bitcoin for Ethereum, they pay a trading fee, and as a liquidity provider, you earn a share of those fees. As one of the many people who stakes to this particular pool, if this pool has a lot of volume, you'll be a recipient for a nice share of the trading fees. This is something that's referred to as yield farming. Yield farming has several definitions within the decentralized finance space. This is one particular thing that can bear the name yield farming. Like traditional market making, there is an adverse selection that the liquidity provider on DeFi will encounter. It goes by the name impermanent loss. It's just really volatility. If the volatility of the marginal swap rate between BTC and ETH, if there's a lot of volatility, that means that that there's going to be a lot of price movements, and arbitrageurs will be consistently coming in and using the pool to adjust the price. They will be the beneficiaries of this arbitrages or price adjustments. And as a liquidity provider being locked up in a smart contract, the liquidity provider is the slow mover and hence the victim of the adverse selection. So that's the disincentive to stake tokens into a smart contract and become a liquidity provider, is for this reason. So in the end, what you do is you try to balance impermanent loss against trading fees, and trading fees in some kind of equilibrium, they should be a little bit more than the loss from impermanent loss. So schematically, this is what it looks like. You have your liquidity providers or yield farmers on one side. You have your liquidity takers or arbitrageurs on the right-hand side, and they meet in this decentralized pool where an AMM decides the price. You see depositing tokens, earning fees, swapping tokens, and paying the fees on the right-hand side by the liquidity taker. So what we do here, three things. We're going to connect the returns and risks from on-chain liquidity provision. We're going to connect these to derivatives markets via innovations in the prices of the underlying tokens. In other words, we're going to look at liquidity pools and like Bitcoin and Ethereum and such. And we're also going to look at their options. And from options, options tell you something about risk. Implied volatility is a measurement of risk, let's say. So if we look at those options on Bitcoin, options on Ethereum, which do not trade on decentralized exchanges, they trade on a centralized exchange. It's called Deribit, is what it's called. Maybe still those options can tell us something about the risk in decentralized exchanges. To do this, we're going to have a mathematical framework in continuous time, Black-Scholes type of framework with Brownian motion, and even with stochastic volatility. We're going to show that impermanent loss can be decomposed into tokens, volatilities, and their correlations. And what we're going to have to do is we're going to have to develop some machinery. Impermanent loss and implied correlation, we're going to have to get some kind of a joint distribution of the two tokens involved in the pool. We're going to have to get some kind of joint risk-neutral distribution for them, and we'll do that using this Hansen and Jaganathan bound. Once we've derived these implied measurements of impermanent loss, we'll do some kind of a cross-sectional analysis of liquidity pools. There's lots of liquidity pools. We can treat each liquidity pool like an asset, let's say. And then we can start doing things like cross-sectional regression or Feynman-Macbeth regression and looking to see if these implied measures that we've developed maybe or maybe not have a premium involved. So hence the cross-sectional reference that was in the title of the talk. Just some literature, some background literature. I'm not going to go through individually what's here. I'll say up top here we have some literature on automated market makers and liquidity provision on decentralized exchanges and impermanent loss. This is sort of the more the newer stuff. And then there's the more classical stuff on option implied information. It's mostly for equities. Things like variance swaps, correlator variance swaps, inverse options. I'll explain what inverse options are later, or maybe in the Q&A we can discuss inverse options briefly. So here's the mathematical framework that we develop. We have this equation like this. So it's very much like the Black-Scholes model, except here there's this sigma I of t, this volatility function, which let's say it's stochastic. So we have a stochastic vol. We have this index I is 1, 2. So I1 would be Bitcoin, let's say, and 2, Ethereum. What happens is that there's this R, this capital R, which is the ratio of these prices. That's the marginal swap rate. Globally, that's the marginal swap rate. What we do is we assume that within a pool, the swap rate or the marginal swap rate within a pool is going to be equal to this R. Otherwise, arbitrageurs move in to make the adjustment. So in a sort of standard continuous time finance setting, we assume that the liquidity pools always maintain that the ratio of the other way around, the number of N2 token divided by N1 is always going to be equal to this R, which equals to P1 divided by P2. And then within this pool, the impermanent loss from time 0 to capital T is going to be minus 1 over 8 T. And then you have this sigma R here. This is the volatility squared of the relative of the R, the relative price, which using Ito's lemma, just some Ito calculus, it can be shown to be equal to this. And so basically, this is going to be the headwind or the risk that is faced by the liquidity providers. And notice one thing. Typically, you can think of Ethereum and Bitcoin is a good example, but there's other examples of other tokens certainly we can think about. But they're going to be positively correlated usually. And so here there's a minus sign on the correlation. And so liquidity providers like correlation. Stronger correlation between tokens means less impermanent loss. in the simplest case, two tokens, 1 and 2, would have, say, same levels of volatility. Sigma 1 equals to sigma 2, and then they'd be perfectly correlated. There would be 0 impermanent loss if the correlation is 1. So that's one thing we're going to look at through options and implied impermanent loss. We're going to find that this correlation, implied correlations, are a little bit lower than statistically estimated correlations. Hence the fear that liquidity providers have for losing correlation. So just a comment here, there's also this thing called loss versus rebalancing or lever, and has some commonality with IL. Milionis, Moemi, Roughguard, and Zhang, they have a nice paper on it. It's just an alternative measure. Lever is going to be in some kind of units of fiat currency or the native token, however you, whichever numeraire you choose. Impermanent loss, on the other hand, is unitless. It's just in variance units. So the standard thing to do when you're looking to price or maybe construct a contract on variance is to do what's called a variance swap. This works well. So what you do is you say, I want to get I want to have a swap. I want what's inside of this expectation to be my floating leg, and then the risk neutral expectation of it, that's the fixed leg of my swap. And so I take risk neutral expectation, I do some Ito calculus, and I see these two parts on the right hand side. I see here this negative 2 over t times the expectation of the log of the price change. So this is what's called my so-called log contract. This thing, through a little bit more calculus, can be shown to be equal to some portfolio of call options and put options. That's actually how the VIX index is constructed, is by approximating this expectation with traded options on, in the case of VIX, S&P 500. There's also this term here, which looks like some kind of fixed leg for a total return swap. For equities, it's pretty easy to handle. It's just going to be 2 times R, or 2 times R minus the dividend yield. And so generally speaking, with equity, with when PI is some kind of an equity price, this term is considered to be rather easy to estimate and is more or less neglected. The main focus is on the options used to get this log contract. Now, for our impermanent loss on this liquidity pool, what we'd like is a valuation of RT's variance, okay? So that's going to be the expectation Q of the impermanent loss. It's going to be minus 1 over 4t. So here we have 2 over t. Remember that the impermanent loss had this minus 1 over 8 in front. So that's just basically minus 1 over 8. So this instead of 2 over t becomes negative 1 over 4t. Here we have this total return leg, and then we have a plus 1 over 4 and this log contract. So the log contract is good. We'll be able to handle this. This thing, not so much. This is a rather pesky term because the relative price has a lot of our risk modeling embedded in it. The expectation of this is going to be, it's going to depend on the sigma 1 and the sigma 2 as well. So this term we can't neglect. So it's a headache for us. How do we handle this term? So the way that we do this is we borrow from the Margrab formula, which the Margrab formula is a formula for evaluating spread options of this sort. And what happens is that with Margrab, there's just this simple trick where you say, I'm trying to price a spread option between two asset prices like so. I can factor this P2 out of the nonlinear payoff. I can bring it outside of this parentheses, and then I have this change of numeraire. And then under this new measure, I have this European option on the relative price. And that's pretty nice because under this change of measure also, RT is now a martingale, which means that that pesky term, that total return that was in the previous slide that I told you that we couldn't handle, under this Q tilde measure, we can handle it. It's not a problem. And so then under this measure, implied impermanent, just expectation tilde of impermanent loss is just the log contract under this change of measure. So in the end, all we want to do is, here's the density. It's just P2 over the expectation Q of P2. We just want to weight all our outcomes by this ratio. We just want to change the numerator to P2. So originally what we did is we were using the US dollar. We were trying to get a valuation of impermanent loss under the risk neutral measure where US dollar or some fiat currency is the underlying numeraire. And now what we've done is we've changed it to the case where P2 is the numeraire. In particular, remember I said we were talking about Bitcoin and Ethereum, so P1 was Bitcoin and P2 was Ethereum, so the native, so in other words, we changed to where the native token is the numeraire. It's not exactly what we wanted. We wanted to get a valuation of impermanent loss under the expectation Q, not expectation tilde Q. But there's some situations, there's some assumptions about the parameters or the processes that would make it so that in the end, they're in fact equal. So for example, if the vols and the driving Brownian motions on the returns are independent, then this would be true. So that would rule out any kind of volatility leverage effect where volatility going up and returns going down, which is common in equities. So this independence would not be realistic for equities, but perhaps in the decentralized finance, it's okay. If you don't like that assumption, you can assume other things like just that the P2, P2, like this one here, is independent of the sigma R. So the relative price volatility is independent of the P2 token. But if there's some kind of assumption like that, we get what we wanted originally, which was this thing right here, the risk neutral expectation. So so that stuff is all pretty standard. What we have to do from here, though, I'll just jump to the bottom line here. How do we get the risk neutral joint distribution Q? So so we want to compute this this tilde expectation of the log of RT. So RT is P1 divided by P2. That's a nonlinear function of these two variables. We need their joint distribution. So we call it Q. How do we get it? Well, we have the risk neutral distribution for P1 and P2. We get those through options, right? We can do a Breeden and Litzenberger formula. In other words, we can differentiate call options on each of these tokens separately. We can differentiate them twice with respect to the strike, and we do that for different strikes, and we get the risk neutral density. But those are only the marginals. We need to get a joint. So the way that we get a joint is that we use something called the Hansen and Jaganathan bound. So what happens is, you see in this equation here, there's this M, which is just the pricing kernel for pricing portfolios on the two tokens. And what we do is we have this, using the Cauchy-Schwarz, you can arrive at this expression here. This is the Hansen and Jaganathan bound. We can try to minimize the right-hand side over all pricing kernels. And it works well for us. We can actually do this. We can show that the minimizer of the right-hand side is going to be equal to the sum of Lagrange multipliers. The Lagrange multiplier that takes the state of one token X as input, a Lagrange multiplier that takes Y, the state of the other token, as input, and there's no duality gap because you can replicate these Lagrange multipliers with options, and so in other words, no duality gap means that this with the optimal, this is actually going to be an equality. The max Sharpe ratio is going to equal to our infimum. The only technical issue that could happen here is that if somehow lambda 1 plus lambda 2 are both equal to 0, in other words, there's the solution at for some xy is an interior point, then your m is going to be 0, and that seems like it would be like an arbitrage, right? Because you're looking for these equivalent measures, so they need to agree on null sets. So that's something that you need to check when you do this optimization, is that you don't hit a null set. But apart from that, the optimization it's a tad bit slow, but it tends to work. It's technical, but it tends to work. It just ends up being, well, I'll show you here. It just ends up being a quadratic program like this. So what happens is mu, this would be your marginal, well, here it's been discretized. So from these densities, the marginal density mu I, that would be the marginal density for Bitcoin. Nu, that would be the marginal density for Ethereum. And you need to satisfy some marginal equations like this. And then phi is just going to be your Q divided by the square root of pi, and it ends up being this quadratic program. So you have to do some work. It's a bit of a headache to code this up, but then you do that, and then you run it, and you get a density phi. You get a joint density that comes out of this, and then you can use it to price your impermanent loss. So that's sort of the financial engineering part of it. What you can do is you can do a number of things. One thing you can do is you can get an implied correlation using a dispersion index like so. So sigma I, this would be the volatility from the index, and then Wi's, these are the weights in the index, and sigma I, sigma j, these are the volatilities on the marginal components of the index, and there's going to be some kind of a rho that's in there. What you do is you do some averaging, and you find a single value of rho that makes the two sides of this equation equal, and that would be your implied correlation. In our case, for the two tokens, these n's would just, this capital N would just be equal to 2. The w's would just be 1s. And again, there's no traded options on this sigma I, but because we've calculated this joint density, we can synthesize or we can get a valuation of an index on these two tokens, and so we can get something for sigma I, and we can compute an implied correlation as well. So let me show you some results with the data. So what we do is we have a lot of data. We have historical annual percentage returns and coin data from these pools. We use Uniswap v3 for Bitcoin and Ethereum pairs. We look at pools with a total value locked larger than $1 million and more than 100 days of history. That's going to leave us with 167 pools. So that's a fairly nice cross-section that we can look at and see if our implied correlations and our implied impermanent losses have any kind of a premium. Let me see, did I mention, I don't think I mentioned here, we get our options data from Amber Data. Amber Data is a data provider, and they provide us with our Bitcoin and Ethereum options for from the Deribit exchange. We have a number of other tokens too, as well as Solana and a few other stable coins as well. So right now we're just talking about Bitcoin and Ethereum, but we're actually expanding this result. I should also point out that it says here V3. We aggregated the V3 data and we use it to compute the indices that I showed you. And if you maybe were a little bit more seasoned in what we're doing, maybe you noticed the formulas that I showed are for V2, which is the older protocol. But we actually, we're revising a paper right now, and we do have formulas for the V3 actually, and we'll have them. They're actually in the paper right now, but they're kind of to the side or in the back of the paper. But we, as we speak, literally as we speak, my collaborator is running our analysis and computing these impermanent losses for the V3 formula, and so we'll have new results soon in the revision. And V3 is important because I'm not going to explain what V3 is, but that's the new protocol. V2 is more or less in the past. So this is just a histogram of what the impermanent loss looks like. It's negative. This blue line is the average, so you can see it's got a bit of a tail to it. Here's Uniswap APRs. they tend to be going down with time for some of the, for this aggregated computation of them. And the net APR, you can see that it tends to be, again, it's got this right skew. Here's the interesting stuff. So implied versus realized 30-day impermanent loss. And this is actually, when I say implied, what I'm going to do is I'm going to put a minus sign on it because impermanent loss is negative, but it makes more sense for us to look at something that's positive. So putting a minus sign again, we'll probably fix our notation, but for now, this is what it means. And you can see here that the blue line, which is the implied, is a little bit higher than the realized, which is typically what you'd expect when you're talking about implied vol. You're going to think that the options are going to reflect something that's a little bit higher than the statistical calculation of vol. So that's what we see here. Similarly, for the 7-day implied versus realized, although the 7-day realized vol is a noisy estimator, but I think from this picture you can tell that it's consistently below. So on average, implied impermanent loss is greater than realized impermanent loss in absolute value if you're keeping track of signs. So, and then of course you can look at Bitcoin implied vol versus realized vol. It also is above, and similarly with Ethereum, implied vol is above realized. Implied correlations. So, so this is, I alluded to it earlier. In blue is the implied correlation, in orange is the realized correlation. And what you can see in Bitcoin and Ethereum is that the implied correlation is consistently lower than realized correlation. And I'll just take a chance to back up here. So this is the impermanent loss, and this was the sigma r, the squared volatility of the marginal swap rate, and it's got a negative 2r there, 2 rho. So typically with Bitcoin and Ethereum, the correlation is positive. So liquidity providers fear that this rho will go down from like 0.8, it'll go down to 0.6 or something like that. So, so that's what you see here in the implied correlation, is this worry from the or at least reflected through the options. It could be reflective of what the liquidity providers think, which is that they fear losing correlation. That's assuming that the liquidity providers are engaged in the options market, of course, which at this time I can't verify, but it would make sense based on this picture. And then here we have some regressions. You can see, I guess, just look at the R-squareds. You can see that if you regress the returns in liquidity pools onto these various drivers, if you include implied correlation along with some implied vol from either Bitcoin or Ethereum, your R-squared will jump from like 67 to 94. So implied correlation is a useful thing to include in a regression. And now finally the cross-sectional regressions. I had my phone set for 29 minutes. I wanted to finish a minute early, and I'm almost done. I'll just show you here for realized individual impermanent loss. We don't find much significance in the Feynman-Macbeth regressions in this cross-section of pools. IIL, we find it to be significant for about 7 days, although here you can see on the right-hand side, this is the t-stats. So after 7 days, the t-stats drop below 2. So for shorter prediction windows, there appears to be some significance. And when we do a multivariate, we can still see some premium for up to 10 days. And also, there's a variance risk premium. That's something we're working on in the revision. I don't have time to talk about it, but obviously when you compute variance and you're looking at cross-section, you want to see if there's a variance risk premium, so that's something we're working on. Thank you very much.